the Bank of Canada has raised its benchmark interest rate by another 25 basis points, marking the first time the figure has hit 5% since 2001. Economists were expecting the move after StatsCan announced that a net 60,000 jobs were created in June. The central bank has been trying to slow the economy in order to deal with the high inflation rates, but growth has been stronger than expected. The bank says strong consumer demand and labor markets are continuing to drive inflation. Meanwhile, we're now seeing chartered banks bumping up their prime lending rates as a result of the rate hike. CBC business reporter Jeannie Lee tells us more.
Well, we tend to follow this scenario every time the Bank of Canada moves, which is hours later, the big banks, the chartered banks, will tend to follow. And that is certainly the case again today after the Bank of Canada announced this decision at 10 o'clock. Now we have the Royal Bank of Canada, the first of the chartered banks to move up their prime lending rates. These are rates that affect basically our guidelines to what they will charge customers for various types of loans. So prime rises also by 25 basis points to 7.2%. And that is a figure you'd have to go back to January of 2001, 22 and a half years, in fact, for prime to be as high as this, 7.2%. And so this will affect instantly lines of credit that were so popular when that long period of time when interest rates were at rock bottom. A lot of people loaded up on their lines of credit, variable rate mortgages, some types that have floating payments, and other types of personal loans. And we'll take a look at this graph now, which shows you how the Bank of Canada's rate decision, and if you look at this, you pretty much can also see a mirror to what the chartered banks charge in terms of prime. It's all going up, basically. And so you have the Bank of Canada, which today moved its prime rate to also a 22-year high, 5% even, when really just 16 months ago, on March 2nd, 2022, it was at 0.25%, as close to free money as you can possibly get without it being actually free. And so this increase is a massive and relentless increase in a very short time, really is to fight the inflation, obviously. And the fact is, though, not only are consumers grappling with inflation, they're also grappling now with those ever-rising payments on certain types of loans. And I'll give you just an example to drive this home. If you had a variable rate mortgage at the rock bottom period, when you could get one for, say, 1.2%, well, the payments on that $500,000 loan, and I just use that as an example, will have gone up now by over $1,200 a month, a difference of 65%. And this is fairly typical, very close to the average for the loans out there that were taken near the bottom.